Welcome to January's webinar from Bob Benny Wealth Management. I'm Bob Benny, and this is my daughter, Jessie Thompson. And we're going to talk about our title of our headline, or our title of our webinar today is, What's All That Racket? And Jessie came up with that title. So what's all that racket about that headline, Jessie? Where'd you go with that?
I'm not going to say.
That's something that my mom, her grandma, sometimes says at her house when there's a lot of racket going on. What's all that racket? Anyways, what's all that racket? How to see through the headlines. Can you tell people how we're going to run this today, Jess?
Yeah, so this is going to take about 30, maybe 35 minutes total. If you think of any questions while we're talking about stuff, there's a little box at the bottom of your screen that looks like a text box. You can type a question in. You don't have to type in your name. We're not going to say your name at the end if you do, but if you think of anything while we're going through stuff, we'll address all the questions at the end.
All right. So we want to talk about the first topic we want to talk about is how the mainstream media affects the stock market. And basically the mainstream media and social media have ulterior motives. You can't take anything at face value anymore. Talk about that a little bit, Jess.
So the primary motive of the news, mainstream news, has not become basically reporting the news anymore. Instead, the main motives are to promote the narrative of the people who fund them, and then also to drive viewership, basically. Right. And so the way that they do that is they basically kind of prey on people's emotions. So they use
particularly fear.
So they use sensationalism, basically, to do that.
Right. There's another ulterior motive that I think might be even bigger than the ones that you mentioned in it, and it's that most of the people involved that own and that work in the mainstream media are leftists, and they are pushing whatever our leftist controlled government is pushing now too. So you can see that the Biden administration, it says something, and then the mainstream news media leftists just mimic it. Just keeps going on and on. It's pretty obvious. Hopefully it's obvious to you.
Especially, in the last probably 5 years or so, I think it's become very obvious.
Particularly this year. This year, they've been toeing the line with the Biden administration almost all along until the truth eventually comes out, like that Afghanistan was a fiasco or that inflation isn't transitory. Once the truth finally comes out, then they kind of get stuck. But fortunately now, a lot of people are getting their news from other sources than the mainstream media.
And it's kind of caused people, I think, to have to take all the news with a grain of salt. Like they can't just take it, like you said, for face value. Right. Instead, they have to use their own discernment and common sense in a lot of cases to decipher for themselves what information they take as true and how they let that affect their emotions and decision making. And that's kind of how the news, I think, can affect the markets in a way. Right. So we thought of a couple of kind of main news subjects that are good examples of the news media having their motives put first before actually reporting the news, and kind of how they've led people astray and spread misinformation the most in the past year. And the first one of those being COVID-19, of course, and basically that the government can save us from it or solve it. And there's been all kinds of misinformation about that regarding treatments, of course, vaccinations, lockdowns, masks, and the effectiveness of all of those things. And they've kind of, we've seen the media dig their heels in on the things that they're saying, even after the truth comes out regarding those things and whether they work or don't work, and that kind of thing.
Yeah, and you know, the ultimate, or the bottom line is COVID-19 is a virus. There's never been a cure for a virus. Sometimes vaccines can help or work, some viruses they never even be able to come up with a vaccine for, like HIV that causes AIDS. And this vaccine that they have for COVID-19 isn't even a real vaccine made up of dead viruses. It's different than that, and many people already know that. But the news media has used this global pandemic to just drive fear and drive fear and drive fear and keep people watching, keep people reading and watching. And one of the things that I've really limited myself with in the last couple of years is watching the news or listening to the news. I only read the news, and I limit the amount of time I spend reading it. Because, you know, it used to be a long time ago when your grandparents, my parents were, when I was a kid, you know, they'd read the newspaper in the evening or watch the evening news, and that was it. Now with these cable news channels and talk radio, people can listen to the news all day long, and it's enough to drive you crazy. So one thing I guess I would suggest for people, as well as using discernment, is to limit the amount of news that they ingest every day, because otherwise it can drive you crazy.
So COVID-19 was a huge news subject that had massive effects, obviously, on the stock market and the economy in the last year and 2 years. But another one is inflation. And until probably the fourth quarter of 2021, the news media and the government were saying that inflation was transitory.
Yeah, they came up with this new, it's not a new word, but the new phrase that it was transitory inflation. It's just going to be temporary. And, you know, first the government came out and, you know, used that talking point, and then the news media mimicked them and, you know, kept spreading that story for months. Well, we know it's not transitory. It's obvious it's not transitory. It became obvious to everyone after a while. Once the truth came out and that it wasn't transitory, then the news media had to kind of say, yeah, well, I guess it's not transitory. Maybe they didn't say that, but they said there is inflation, and significant inflation.
Right. And just an interesting fact is the amount of money that's been pumped into the economy because of COVID-19 is massive. So it's at $10 trillion right now. So 6 trillion of that is for COVID relief, including $1 trillion in just the stimulus payments. And then 4 trillion of that is in Federal Reserve quantitative measures of buying bonds and things like that to kind of artificially pump up the economy. But that $10 trillion number, just for some perspective, World War II is the most expensive war in the entire history of the United States. And in today's money, so today's dollars adjusted for inflation, World War II cost about $4 trillion. And we spent $10 trillion.
Yeah, 2.5 times as much as what World War II cost. And it's not just spending the dollars, it's creating the dollars out of thin air. And that's what causes inflation.
And the government did that and then tried to say that it was transitory, knowing that's exactly how you cause inflation, and inflation that's going to be here to stay for a while. Massive inflation. That's a massive amount of money. And just a quick chart that shows what we're talking about here as far as the amount of money that's circulating right now because of COVID measures. This is basically the most liquid cash that's circulating in the US right now. And this is the historical chart of it. And as you can see in
starting clear out at around 1975 on the left there.
Yeah, the amount of money that's been pumped into the economy to circulate in 2020 is just absolutely huge. And to deny that inflation,
to say that it's transitory was nonsensical, and it was a lie from the beginning from the government, and a lie that was perpetuated by the mainstream media to go along with them. And then, but like I mentioned earlier, the phrase, the truth, I just always believe that the truth eventually comes out. And sure enough, after several months, the truth eventually came out, and that the news media actually even had to admit that it's not, and the government, that it's not transitory inflation.
So we know that the fundamentals of the stock market are very rational, but it is still influenced by investor emotions. So because it's still influenced, investor emotions are a driver of the stock market, not the primary driver, or even really a main driver of the stock market.
But they can certainly be a temporary driver.
They can influence it temporarily, right? And so we had a number of news stories in 2021 that could have influenced the market.
And sent it spiraling. And if you just listen to this list she's going to read of these news stories, one might think that the stock market shouldn't have made any money in 2021 at all, but we're going to tell you different in a minute.
Yeah, so first we had a contested presidential election.
Little contested.
Yeah, and then we had the January 6th Capitol situation. We had Biden's $1.9 trillion COVID relief bill. And soon after that, he kind of threatened to pay for that by increasing corporate tax rates.
Income taxes.
And then we had supply chain problems. We had sloppy exit from Afghanistan.
Sloppy
To say the least. And then we had OSHA come out and try to mandate vaccines for private employers of over 100 people in September. And we also had Delta and Omicron variant kind of fear and
constant through all this. We had COVID. 90% of the news stories were about COVID-19 and that. So you would think that would really be bad for a bad deal for the stock market with all those negative news stories, was it?
Actually, in spite of all of that stuff, the S&P went up 26.9% for the year. The Dow Jones gained 18.7% and the NASDAQ gained 21.4%. So I'm going to show a chart actually of the S&P 500 for 2021, and you can kind of see where the dips in the stock market are based on kind of the current events or the news that was going on. The news stories and the effect at the time.
Right, the effect of some negative news stories on the market.
Okay.
So there's the beginning of 2021. And the blue line, of course, is the graph of the S&P 500.
And this is weekly, so it's not going to show like things that happen on specific days. But
she's just put in there the different news stories. Go on through them, Jess.
So the first one is the election concerns. In January. In February, I had almost forgot about this, but we had that huge winter storm and energy crisis that happened all throughout the Midwest that dipped the market for a little bit. In May, inflation numbers were released showing 4.2%, which was the highest inflation or CPI percentage since 2008. And that kind of got people starting to freak out about inflation.
Significantly higher, I'll point out, than the 2 or 3% that we've been experiencing over the last several years.
And so the CPI numbers are released around the 10th of each month. And if you look at the S&P 500 throughout the year after that date on the 10th of each month or around the 10th of each month, when those numbers are released, there's a little dip because it was scaring people because they continued the numbers continued to increase all throughout the year. In July, the Delta variant became prominent in the US. And then in September is when OSHA released their vaccine mandate for private employers. And September was actually the worst month for the market in 2021. And then the market came back up around Thanksgiving time or right after Thanksgiving. It took another dip, mostly because the Omicron variants became prominent. And then people were also worried about holiday supply chains.
So the news can temporarily affect the markets, but ultimately we believe, and I know from experience, that what are called market fundamentals prevail. The fundamentals being that companies are in business to make money, and the more money they make, the more the company value is. It's just like across the street from my office, always use this example, across the street from my office is a car wash. And if you were thinking about buying a car wash and you came to me and asked me to help you figure out whether that was a good investment or not, and what we would look at to decide whether to buy the car wash and how much we would pay for it is the earnings of the car wash. The more money the car wash makes, the more money we'd be willing to pay for it. Well, that's the same kind of thing with every single company that's on the stock market that people invest in. The more money they make, the more projections of future growth of their earnings causes their value or their prices to go up.
So kind of an example that we wanted to use of how panic and emotions and kind of news driven panic can affect the markets is in 2020 in March, in like a month and a half span of time, the S&P 500 dropped 34%, which was huge. And a lot of people panicked.
And that was just to remind everybody, it was just started kind of in January and then February that the news media and all the news was all about COVID and China and all this stuff with this virus. And that caused the stock market to go down significantly, over a third. You want to show them that chart now?
Yeah.
Yeah. Let's show. And this is a 5-year chart of the S&P 500. Where is it? It's on the.
It's right here. It just refreshes because it's.
Maybe it's going to refresh. In Yahoo Finance, I mean.
It's refreshing.
Oh, okay. There you go. I mean, I'll go to, there you go. Okay. Go to the 5-year. Okay, this is a 5-year chart of the, maybe you hit full screen on that. I think that'll help. Right? No, it says full screen right below your pointer. Okay, so you can see in early 2020, the big dip in the stock market. That's the time period that Jessie was talking about. Go back to the peak, show where the peak was right to the left. Right there was February the 10th. And then kind of try to show where the bottom is. Yeah, around here, the middle of March. And then, but look at how long does it take before it came back up to where it was on February the 10th. Keep scrolling over. Yeah, about right to there. So by August, it was already higher than it was before it went down. When this happened, we had some clients call, not a whole ton of clients. When it happened, when it went down, we had some clients call, worried, wondering if we need to get out of the stock market because their accounts had gone down at the bottom. It had gone down by a third. Some people's accounts had gone down by about a third. But we advised them, I advised them, don't panic. This is an overreaction. It's a news-driven overreaction. This virus is not going to cause and did not cause the earnings of companies and correspondingly their values to go down by a third. And I advise people that it's going to come back. Might take whatever, 6 months or a year, but it's going to come back. And indeed it did. It turned out I was right, luckily.
And it actually ended up at 18.4% higher than it was the year before. So it came back. The not only came back, but it grew significantly in the year. Came back
to where it was before it dropped, and then ended up 18.9% up for the year. And so I guess kind of a general theme of our webinar is that we don't want to let fear cause us to fear, this being unfounded fear driven by the news media or social media, cause people to make mistakes with their investments.
Yes. And kind of, I think, a reminder that current events and things that are going on in the media is maybe a driver of the market, but not the driver of the market.
Right.
And it's just a small
Right. And,
factor.
you know, and in the most recent past, a kind of driving thing that's caused the market to go down for the last couple of weeks, a little bit, it's up quite a bit today, has been the news media talking about inflation, or I mean, interest rate increases, the Federal Reserve increasing interest rates.
As a result of inflation.
Right, because that's the government's basically their only tool to combat inflation, which now they've admitted is happening, is to raise interest rates. Eventually, interest rate increases may have an effect on company earnings. But the financial news media is now trying to scare people and telling them that interest rates are going to take the wind out of the stock market, and it's not.
So we don't think that the biggest threat to Americans in 2022 is some kind of a big market correction or anything like that. The biggest threat to Americans in 2022, we believe,
is high inflation.
Yes.
Hyperinflation. I call it hyperinflation.
Yep. And the last numbers that the CPI numbers that they released from December was 7%, which is the highest since 1982 when it was 7.1%.
But that CPI number that Jessie's talking about, that's up 7% for the previous 12 months, ending in December, does not include energy costs. So the actual inflation that we're experiencing, Americans are experiencing, is even greater than the 7%. I believe that the inflation that we're going to experience for a while, years probably, is going to be very significant. And that's the greatest financial threat to all Americans, whether it's very wealthy Americans or middle-class Americans or poor Americans. Even if you're a poor American, yes, all your expenses are going up significantly, and your earnings probably aren't going to go up as much enough to take care of it.
So what should investors do if we know that inflation is going to be our biggest problem in 2022?
That's a great question. I've been talking to our clients and prospects about this for the last several months, because I knew that this wasn't transitory inflation last summer.
We had a webinar on it.
Right.
In like May or something.
Yeah.
Where we said that.
Right. And so when you know that inflation is happening and it's going to continue, and it's going to, I've been telling people there's three worst investments to have, worst places to have your money, and three best places to have your money. The three worst places to have your money are cash, which is also including checking and savings accounts, because you're losing buying power with that cash. CDs aren't making anything. They're just about as bad as cash because they're only making under 1% a year. And then bonds. Bonds are paying a little bit higher interest rate than CDs or checking accounts, but at 3 or 4% a year, that's still not enough. And keep in mind, folks, that when interest rates go up, bond prices go down. It's like a teeter-totter. It's a mathematical thing. If interest rates are over here on this hand and bond prices are over on this hand, if interest rates go up, bond prices go down, bond market values go down. So as interest rates go up, your bonds are going to go down in value probably by less than the interest that they're paying. Plus, you're losing buying power with those bonds. And so the problem with the buying power thing, just to kind of remind you, if you think about it, I've had a number of people come to me and talk to me about that they have it seems like $100,000 is a magic number. I have $100,000 in the bank. What should I do with it? I'm kind of scared about what's going on with this inflation and everything. Well, if you have $100,000 in the bank and you leave it in the bank and don't make virtually any interest on it, in a year with 10% inflation, you're going to be able to buy $90,000 worth of stuff. That's why you don't want to have money sitting in cash or savings, checking, those kind of investments. The three best kinds of places to put your money when you know there's going to be inflation. If you think about what I've been explaining to people, is my definition of inflation is the rising cost of goods and services. The rising cost of goods and services. What better hedge could there be against inflation than owning the companies that produce and sell the goods and services whose prices are rising? And so I believe that companies in the stock market, whether that's in individual stocks or mutual funds or what we use, index funds, ETFs, exchange traded funds, are the best place to have your money when there's going to be high inflation. And that's worked out so far. That's number one. Number two is income producing real estate, whether it's rental houses, apartments, or farmland, because both the value of the real estate is going to go up with inflation and the rent is going to go up too. And then finally, and my least favorite is gold. Historically, gold protects your money against inflation, but I don't like it as much as income producing real estate or companies, because if you think about it, gold doesn't produce and sell anything. It doesn't pay any interest. It's just gold, and it will eventually go up. And there may be a time when it's good to be in gold, but I don't think right now is the time yet. But that is something that some of our clients have some money in.
So looking forward kind of to 2022 as far as an economic or market outlook, in December, the Fed released that they plan on 3 rate hikes in 2022, the first one starting in March. And they also announced that they are basically tapering back on their bond buying, and that they plan on completely ending that in March as well. And then they plan on 2 more rate hikes in 2023 and 2 more in 2024. So when that was released, people kind of started freaking out a little bit, basically just, even though it hasn't even happened, just on the news of it. And we kind of project that when they happen, people are going to freak out a little bit, and it's going to be just a temporary drops in the market every time. And historically, what's happened when the Fed has raised rates like that that's exactly what happens. There's a temporary, very short panic that people have that causes just a little drop in the market, and then the market continues to grow. And actually, what I read is in the 12 months following a rate hike, the market actually grows, I think, at an average of 20% is the number that I read historically.
Basically, though, if you think about interest, because companies borrow money, not all companies, but many companies borrow money, and interest is a cost. And so if their costs go up, their earnings go down. But what we're talking about with these rate hikes with the Federal Reserve, maybe there's going to be 3 rate hikes in 2022. Typically, they increase the interest rates by 1/4 of 1% or 1/2 of 1%. Even if it was 1/2 of 1% every time, that's still only a 1.5% increase in interest rates to companies. That's not going to affect their earnings hugely or significantly. That's not going to take the wind out of the sails of the stock market. Eventually, once interest rates get up plenty high, over 5, maybe 10%, if they do, and they probably will, that's going to affect companies' earnings, and that might slow down that will reduce their earnings and have an effect on their on the stock market. But it's not going to happen for a while. The only thing that's going to happen now that's going to cause the stock market to go down because of these interest rate increases is temporary panic and fear driven by the news media. You know, the 2 biggest emotional mistakes or emotions that cause investors to make mistakes are fear and greed. And that right now, people need to make sure that they're not fearful.
So the other thing that we predict for 2022 is basically continued rising inflation. So the Fed is going to try to fight inflation with these rate hikes, but that doesn't immediately fix the problem, and it's not going to fix the problem for a while. So we're going to be dealing with inflation in 2022 and in future years, most likely. So that's why those 3 best investments for inflation are important.
Right. And, you know, I've been telling people too that there's kind of tailwinds, I call them tailwinds, pushing the stock market up. And there's really only one whole headwind that's a potential headwind that could take the wind out of the sails of the stock market. Some of the tailwinds pushing the stock market up are lower corporate income taxes. A few years ago, the Trump administration, Trump lowered corporate income taxes from 35% down to 21%. That's a big drop. That's a huge drop. What that did was it increased the earnings of every single company, even if they didn't sell one more widget or increase their efficiencies or anything. If everything was the same 1 year to the next from 35 to 21%, it grew their earnings for their investors, for the stockholders by over 20. And that's still in. They haven't raised income tax rates for corporations yet. So that's positive. There's also significant regulatory cuts that took the regulatory burden and expense off of the financial backs of corporations. Those two things are going on and are still going on and are still helping drive. Opening up the economy, opening back up after the restrictions from because of the virus by the government. Companies, that's been going on, and that's helping drive earnings up, sales and earnings up of companies. We've been in a technological revolution for more than a couple decades now, and that technological revolution has just accelerated because of the COVID-19 and some of the different restrictions and people working from home and stuff like that. Like now, now we're doing this on a Zoom meeting. How many of you watching this Zoom meeting ever even had heard of Zoom before 2 years ago? We did. We used it with clients out of state occasionally, but most Americans and most companies didn't communicate this way prior to a couple of years ago. DocuSign, which is the way that we sign documents with clients electronically. Both Zoom meetings and DocuSign and all kinds of other technology have lowered companies' costs. And when you lower company costs, it increases their earnings and makes them more valuable. Those are just three of the tailwinds pushing the earnings up and the stock prices up. The only really significant headwind, I think, that could cause the stock market to drop is our government right now being controlled by leftists, which like higher taxes and like more regulations. Unfortunately for them, they haven't been able to get this corporate income tax increase passed, and it doesn't look like they're gonna. And so because of that, I think that I think the stock market is going to continue to be very healthy in 2022. And because of the hyperinflation, remember that concept of the rising costs of goods and services and the owning the companies that produce and sell the goods and services whose costs and whose prices are going up. That's my opinion as a financial advisor, that's the best hedge against inflation that we can offer people.
So we're going to wrap things up and see if we have any questions. It looks like we have one here. Somebody asked, will the Biden administration's policies affect the stock market? And you kind of hit on that just a little bit.
Yeah, their policies, if they could get all their policies that
passed,
they wanted to, they would negatively affect the stock market. When they came out with the, I guess it's, they had this COVID-19 thing that they passed at $1.9 trillion right off the bat, even though we were already dealing with COVID-19, they wanted to spend some money, $1.9 trillion in February. Well, then in April, President Biden proposed at the time he called it his infrastructure package. And it had a lot of climate change stuff in it, stuff that really wasn't infrastructure, but he called it infrastructure. It was 3-point-something trillion dollars. Well, when I started looking at that, they did have a corporate income tax rate increase in there. Remember, I told you before that Trump lowered it from 35 to 21. Well, the thing I noticed went in this infrastructure bill in April that President Biden and his administration and the Democrats supported was the increase was just to 28%. And I looked at that and I thought, they want to go from 21 to 28. Why not to 35? They say that everything President Trump did was terrible. They want to undo everything he did. Why didn't they undo this? Why didn't they go to 35? Or being the socialist leftists that they are, why didn't they go to 50? They want all that money. Anyway, why just to 28? Well, the reason was because they didn't have the votes. I knew at that time, they don't have the votes to go to 35 or 50 or anything else. They think they can get the votes maybe at 28. Well, they didn't have the votes for 28. They even lowered it last fall to 26 and still didn't get it passed. And I'm not saying that's the only reason this didn't get passed. I think it didn't get passed because, particularly because Senator Manchin and Senator Sinema from Arizona didn't like all the excess spending going on in it. But it's good for us and it's good for the stock market. They didn't pass anyway. But when they re-proposed it multiple times in the fall, they had lowered that corporate income tax rate from 21 to 28 only to 26. Well, a 26%, going from 21 to 26 or 21 to 28 isn't going to crash the stock market. It's going to take a little bit of the wind out of the sails. It's going to lower corporate profits a little bit because of that excess cost of taxes, but it's not going to kill them. So I'm very bullish on 2022 and the stock market and hope that you are too.
Looks like we got a couple other ones here. Okay, it's a good question. Do you have an opinion on cryptocurrencies, both as a general investment and also as a hedge against inflation? What do you see as a potential headwinds for crypto?
I wouldn't invest in cryptocurrencies myself with a 10-foot pole. It's I'm very uncomfortable with cryptocurrencies, and I'm way more, even though I'm saying everybody ought to have all their money in the stock market right now, that's not near the risk these cryptocurrencies are. And I'm just not comfortable with cryptocurrencies at all.
You think it's too speculative?
Way too speculative for me or for our clients. And, I mean, if somebody wants to speculate, speculate with a very small portion of your money. Kind of like, if you're going to go to Las Vegas or go to the casinos and gamble, just think of it like that you're gambling. You're not really investing, you're gambling. And if you keep that in mind and only do it with a very small portion of your money, that's fine. So if you try that with 5% of your money, no more than that, and you lose the 5%, it's not going to kill you. Maybe you'll learn a good lesson about gambling. Maybe you'll make some money, but I don't think anybody's going to get rich doing that. Or I just, it's too high of a risk. What's the next one?
Okay, the next one, I'm hearing the government will try to cause deflation. Is this possible? And what effect will that have for 2022?
You may be hearing that the government would like to cause deflation. I'm sure the government would like to cause deflation. I just don't know how they're going to do it. Really, the only way you could cause deflation is to take money out of the system. And they don't really have a way of doing that. And so I don't see that as happening in 2022. I don't see it. That's just my opinion.
Okay, we got one more. What sectors do you see as the best and worst places to be for 2022 given predicted inflation?
I'm most comfortable with large company stocks versus mid-sized companies or small companies. As far as sectors are concerned, I believe a lot in technology. I think we're just going to continue to, companies are going to continue to leverage technology to lower their costs and become more efficient and increase their profits. So my favorite, I would say, would be technology of sectors. Energy sector is going to be good, I think. Maybe the least of sectors might be real estate, but I'm not sure.
Sure.
More is from a macro standpoint, I think you're safest with larger companies. I would lean it more towards growth companies and technology. Stay away from small companies, and I definitely stay away from foreign investments. I've been advising all our clients and people in their 401ks not to have money in foreign funds. They're too volatile and they're not worth the added risk.
Okay. Let's see, we've got one more and then we're gonna have to wrap it up. And if you have any other questions, you can email them to us, or if you put it on here, we'll make sure to
Do
get
you
back to
see
you.
any
Put your name.
change in housing costs for 2022? I just think that it's just a part of inflation, that rents are gonna go up and, you know, real estate, houses are gonna keep going up. I don't know, you know, they've gone up a lot. Maybe they'll slow down going up a little bit, but if you're thinking about buying a house, if I was gonna buy a house, if I was thinking about buying a house in the next year or two, I would buy it sooner rather than later. For two reasons. One, because in a couple of years, that house is gonna cost you more money. And the second is if you need a mortgage, interest rates are lower than they're gonna be in a couple of years. So, or even in a year, interest rates on 30-year mortgages have already gone up. They just, the average the other day, earlier this week, national average is about 3.75%, which is still dirt cheap compared to, you know, the double digit interest rates on mortgages. They got up to as high as 18%, you know, in the late 70s, early 80s.
Yeah, what was yours, 8?
My first
First
one
house?
for the first house I bought in 1984 was 8%. And I thought I was getting a bargain. Nobody would even, everybody would croak if they had to pay 8% on a mortgage now. But anyway, thank you very much for
Thank you.
attending. And certainly if you have any further questions, feel free to email us or bob@bobbenny.com or Jessie@bobbenny.com, or you can call our office at 402-421-2626. And we just both thank you very much and hope you have a blessed day.